Inside the wiretap, Raj Rajaratnam's Wall Street insider trading scandal. In the high-stakes world of Wall Street, where billions of dollars change hands in the blink of an eye, information isn't just power, it's currency. And in this game, the line between legal advantage and illicit gain can be razor-thin. Few stories capture this tension as vividly as the rise and fall of Raj Rajaratnam, the billionaire hedge fund manager who used wiretaps not just to listen in on deals, but to rewrite the rules of insider trading. Raj Rajaratnam wasn't your typical Wall Street trader. Born in Colombo, Sri Lanka in 1957, he moved to the United States in the late 1970s and earned an MBA from Wharton School of Business at the University of Pennsylvania in 1983. By the early 2000s, Rajaratnam founded the Galleon Group, a hedge fund that, at its peak in 2007, managed $7 billion in assets and was one of the fastest-growing funds on Wall Street. With a net worth estimated at over $1 billion, he was seen as a master investor, known for his shrewd market intuition. But beneath the surface of this financial titan was a network geared not just toward complex trading strategies, but sophisticated espionage operations. To understand how Rajaratnam's empire was built and ultimately destroyed, we need to look at the gritty mechanics of insider trading and wiretapping in the context of global finance. Insider trading, at its core, involves buying or selling a security based on material, non-public information. The U.S. Securities and Exchange Commission and the Department of Justice, DOJ, have long cracked down on this practice because it undermines market fairness. Yet, in practice, it's notoriously hard to prove. Until the 2000s, successful insider trading prosecutions were relatively rare, often limited to cases with clear paper trails or self-incriminating confessions. Rajaratnam's Galleon Group operated at what prosecutors would call the intersection of hedge fund trading and illegal information networks. The key differentiator was his use of wiretaps, court-authorized recordings of phone conversations to document conversations that revealed insider tips exchanged in real time. These wiretaps, authorized in 2007 and conducted by the FBI and federal prosecutors, became the first time telecommunications intercepts were used successfully to prosecute insider trading. But what drove the government to use these tools, and how did Rajaratnam and his network operate? The investigation, known as Operation Galleon, was launched after the SEC noticed unusual trading patterns ahead of major corporate takeovers and public announcements. For instance, in 2008, the Galleon hedge fund realized extraordinary profits of $45 million by trading information related to the takeover of Hilton hotels by the Blackstone Group. This tip was never publicly available, but Rajaratnam and his team bought and sold stock with a precision that could only have come from privileged knowledge. The wiretaps revealed a sprawling web of informants, corporate insiders, consultants, and other traders who fed Rajaratnam critical information. These included employees at Intel, McKinsey & Company, and Goldman Sachs, among others. Conversations ranged from casual to explicit, capturing discussions of upcoming earnings reports, mergers, and other market-moving events. Prosecutors described this as market surveillance on steroids. Hundreds of hours of recordings capturing Rajaratnam instructing traders to buy or sell hours before public announcements. The legal filings outline an example. In one wiretapped call from 2008, Rajaratnam was heard asking a contact for any juicy tidbits about a company's quarterly earnings. The contact provided projections that were not yet public, allowing Galleon to position their trades perfectly. These profits were not insignificant. Between 2004 and 2009, prosecutors estimated Rajaratnam and his associates earned over $60 million in illegal gains from insider trading. But the story of Rajaratnam and Galleon is more than just wiretaps and secret meetings. It's a stark example of the power of information asymmetry in financial markets, and how complex networks can exploit it at scale. The Galleon Group's internal structure facilitated this. Rajaratnam's organization wasn't just a hedge fund. It was a hub for gathering and interpreting confidential information. He surrounded himself with a team of analysts and traders whose job was less about traditional research and more about cultivating sources. This included corporate executives, technology insiders, and consultants, who could supply market-moving information before its public release. For example, Anil Kumar, a senior partner at McKinsey & Company, was one of the key insiders feeding information to Rajaratnam. Kumar passed along sensitive data about clients' financials, upcoming mergers, and strategic shifts, information that gave Galleon a substantial trading edge. The SEC and federal prosecutors allege that Kumar's passing of insider information was motivated by both personal friendship with Rajaratnam and the prospect of financial rewards. To give viewers a sense of scale, the SEC's complaint named over 20 individuals connected to this network, including analysts, corporate insiders, and traders. The diversity of these informants signals just how layered and widespread the insider trading system had become, crossing multiple sectors and geographies. It was not a single rogue trader acting alone. It was an institutionalized conspiracy. Rajaratnam himself was arrested in late 2009 in what became one of the highest-profile insider trading busts in history. The FBI didn't just rely on the wiretaps. They also employed traditional surveillance methods like electronic eavesdropping, emails, and witness testimonies. The resulting case was a turning point in Wall Street enforcement, signaling a new era of aggressive crackdowns on hedge funds using innovative investigative tools. In 2011, after a 6-week trial in Manhattan, Rajaratnam was convicted on 14 counts of conspiracy and securities fraud. The jury found overwhelming evidence that he had orchestrated a fraudulent insider trading scheme spanning multiple years and corporate sectors. The judge sentenced him to 11 years in prison and imposed a $10 million fine, the longest sentence ever handed down for insider trading in the United States at that time. But the impact of this verdict went beyond Rajaratnam. It sent a shockwave through hedge funds and Wall Street investment firms, many of whom suddenly found themselves scrutinized under a microscope. The case also triggered widespread reforms, forcing regulatory agencies to sharpen their investigative techniques and hire technology experts to track communication networks. The scandal also exposed systemic vulnerabilities in financial markets. Why were so many insiders willing to share confidential information? The answer lies partly in the incentives embedded within corporate cultures and professional networks. Executives and consultants often faced immense pressure to deliver results or curry favor with influential traders, a market dynamic the Rajaratnam conspiracy exploited ruthlessly. Consider the human cost beneath the headlines. The conviction of Rajaratnam also ensnared several other executives and insiders. Anil Kumar pleaded guilty and cooperated with investigators, serving a reduced sentence. Others, like Rajat Gupta, former head of McKinsey and a member of the board of Goldman Sachs, were also implicated and convicted. Their professional reputations, once sterling, lay in tatters. But insider trading isn't just a crime against corporations or individual investors. It undermines the very foundation of trust that financial markets depend on, the principle that all investors have equal and timely access to relevant information. When information becomes the province of an exclusive elite, markets become less efficient and more volatile, driving away capital and eroding confidence. For everyday investors, the Rajaratnam case is a stark reminder of how the invisible hand of the market can sometimes be tilted by invisible wires and clandestine calls. Hedge funds managing billions of dollars wield enormous influence over markets. But if their advantage comes from illicit leaks rather than analysis, the whole system risks losing its legitimacy. At the same time, the case pushed regulators and market participants to embrace transparency and accountability. The use of wiretap evidence in this case marked a new tool in the enforcement arsenal against financial crime. Previously, wiretaps had been almost never authorized in white-collar cases due to concerns about invasion of privacy and legal constraints, but their success here paved the way for more aggressive, tech-enabled investigations. In the years following Rajaratnam's conviction, the SEC and DOJ intensified their efforts to root out insider trading, leading to several other high-profile prosecutions. The globalization of markets and digitalization of communication only made these investigations more complex and necessary. Take, for example, the 2020 conviction of Matthew Martoma, a portfolio manager at SAC Capital Advisors, who secured $276 million in illegal profits using insider tips. Cases such as Martoma's trace their lineage back to Operation Galleon, which established prosecutorial tactics and standards for evidence. Looking at the bigger picture, the Rajaratnam saga illustrates a broader phenomenon in the global economy: the struggle between ever-evolving financial innovation and the regulatory frameworks designed to keep markets fair. Hedge funds, with their aggressive strategies and opaque operations, sit at the heart of this battle. While they can generate enormous wealth and liquidity, they also pose systemic risks when incentives go unchecked. Rajaratnam's story also underscores the growing role of technology in both market manipulation and detection. The same tools that enable rapid information flow and complex trading strategies can also facilitate illegal schemes. Conversely, advanced analytics, surveillance algorithms, and cybersecurity measures have become vital in detecting suspicious patterns and connections. In fact, after the Rajaratnam case, regulators increasingly focused on data-driven investigations. They began to monitor trading patterns suspiciously timed to corporate announcements, digitized communications, and the social network of traders and insiders. This shift marked a new chapter in financial crime enforcement, one where technology aids transparency as much as it enables complexity. Rajaratnam was released in 2019 after serving 8 years, but his story remains a cautionary chapter in Wall Street's history. The hedge fund he built no longer exists, and the legacy of the Galleon case serves as an enduring lesson in the limits of unchecked ambition and the importance of rigorous enforcement. At the end of the day, Raj Rajaratnam wasn't just a hedge fund manager who broke laws. He was a symbol of a financial ecosystem grappling with its own vulnerabilities and ethical dilemmas. His use of wiretaps was groundbreaking because it revealed the hidden conversations and shadow networks that had long eluded regulators. It was one thing to suspect insider trading. It was another to listen in real time, and catch the conspirators red-handed. The Galleon case is far from an isolated story. It reflects a pattern repeated across financial markets worldwide, where the battle for advantage pushes ethical boundaries. Whether it's whistleblower revelations, data leaks, or high-profile prosecutions, the pursuit of market fairness is an ongoing challenge. What remains clear is that information in finance is a weapon. How that weapon is wielded defines not only individual fortunes, but the integrity of global markets. Rajaratnam's downfall illustrates the cost of abusing that power, and the evolving arsenal regulators must deploy to keep markets honest. In an era defined by data and speed, the Rajaratnam story pushes us to ask, are our financial markets becoming more transparent or just more complex? And as regulators harness new technologies to pierce the opacity, will the next insider trading ring emerge in plain sight or disappear even faster behind encrypted messages and blockchain transactions? This episode in Wall Street's history is a stark reminder that in markets ruled by information, the means of surveillance can become the means of justice. The mechanics here were almost laughably simple, and that's why nobody caught it for years. But once the wiretap started, the truth was hard to hide. Wiretap by wiretap, call by call, the curtain was pulled back on an insider trading empire that had taken Wall Street by storm, and the world watched as it crumbled. If you found this story interesting, hit that like button and subscribe so we can keep making these videos. Tomorrow, we are diving into a story that is just as shocking. Raj Group, the $1 billion private equity fraud. You will not want to miss it. I will see you there.